multi-asset funds are well positioned to add value to investor portfolios by focusing on delivering long-term real returns, especially given their wider investment toolkit. Joining me today to discuss the PSG Balanced Fund and how PSG Asset Management approaches managing its multi-asset portfolios is Head of Equities, Justin Floor. The PSG Balanced Fund sits in the CISA South Africa multi-asset high equity category. So to kick us off, can you remind us what the objective of this fund is and what the potential value is that it brings to investors?
Hi, Audrey. Nice to be with you today. So, the Balanced Fund's a classic growth vehicle. It's your classic fund that you go for your retirement needs. It's what we'd call an accumulation fund. So we're really thinking about capital growth first and foremost, but it's wrapped in a Regulation 28 constraint. So it's very suitable for pension funds and RAs and that type of thing. And it's more diversified than a classic equity fund. Okay, so it's really designed. We run it with an objective of around CPI plus 5 after fees as our broad long-term target. We hope to do better than that over time. And we're also hoping to do better than our competitors as well. So that'll be broadly the objective. So it's a real capital growth, but at a lower risk than a pure equity fund.
So there is a lot of research out there that shows that investors in general earn less than what's available in the market. In fact, you recently wrote an article about this in the Angles and Perspectives, referencing the Morningstar Mind the Gap survey. So how do you think does investing in a fund like the PSG Balanced Fund help investors to avoid some of those pitfalls?
Yeah, it was a really interesting article, and it's obviously research that Morningstar has been doing over long periods of time, but their most recent iteration came out a little while ago. And what was really interesting was, effectively, if you just had to define the problem statement, was what they found is most individual investors were getting a worse outcome than the underlying funds that they were invested in. And the simple reason why comes down to investor behavior and trust. And effectively what's happening is it's a quantified measure of how people disinvest at the wrong time, often selling low, switching at the wrong time, and maybe buying high. And that's almost like a permanent negative drag, which was quite large if you measured over the sample period. Now, what was really interesting for me was in that data, what you found was investors in multi-asset funds, so funds like the Balanced Fund, had the lowest gap. And I thought that was really interesting. And I think one of the reasons for that is it's because those investors get two things. One is they get a manager that will flex their asset allocation for them. So they feel less pressure to switch and to change the asset allocations themselves because somebody's doing it on their behalf. And so there's less temptation to switch. And the second thing is it's a more diversified fund. Okay, so you're not going to have the massive highs and lows of maybe a specialist equity fund where you have to try and time it quite sharply if you're doing it on your own. So I think, if you come back to the Balanced Fund, that's one of the core, I suppose, value propositions of a fund like this. It's a fund that, if you think about it carefully, you can really buy into it and then hold it for the long term and just let it do its thing. And certainly if you look at the track record over time, that's where the benefits come. It comes over long periods of time and just letting that compounding happen.
So Justin, on the flip side of that, we have recently seen something of a resurgence in the building block approach. But how does the benefits that the PSG Balanced Fund, for example, as a multi-asset fund that's managed by a manager, how does the benefits of that stack up comparatively?
Yeah, we had an interesting time at the moment. So there's two schools of thought now. And the one is what we call the building block approach, which is where fund allocators that sit outside of the asset managers will be doing the asset allocation, and they use specialist building blocks products to try and put it together and try and meet their client objectives. The other approach is much more of the classic multi-asset model, which is fund managers are appointed to run multi-asset portfolios to meet those solutions. So it all sits, that full value chain sits in the asset manager, and they're making all those decisions. Now, it comes down to personal preference and what the needs are, and also what the relative skills are and capabilities are at the different layers. But maybe just to point out a few of the advantages of running an integrated multi-asset solution like we do in the PSG Balanced Fund. So there's a few big ones. The first one is what you've got a manager that can flex as your asset allocation much more dynamically. They're typically closer to the market. They're getting these bottom-up signals on a live basis in their portfolios, and they're able to very dramatically switch into market dislocations if required. Sometimes that's harder to do when you're sitting quite removed and you don't actually know what your underlying asset managers are doing on a live basis. So that's the one key advantage is you're able to be dynamic and quite timely in terms of your implementation. The second big advantage, this is probably the biggest advantage, is that you're much better able to construct a portfolio that is well integrated. And what I mean by that is, as a portfolio manager, I can really select my global stocks and my fixed income securities, cash, local equities, in a way that they complement each other so that the overall risk of the fund is really nicely managed. It's much harder to do when you're sitting at a helicopter view and you're putting in these building blocks together. You don't actually know how the different fund managers, they might be holding securities in one bucket that actually completely offset or nullify the benefit somewhere else. And you're almost diversifying as opposed to kind of getting the best possible benefit. So I think having that full look through to the end security portfolio integration, end up with if it's done well, with better returns and better managed risks. I think those would be kind of the key ones. There's a third one as well, which I think is also quite important, is that if you trust your asset manager to do the full asset allocation for you in a multi-asset fund, you're getting a consistent application of a process and philosophy. So you're not marrying or merging varying philosophies which might be working against each other. You're actually getting something very consistent that comes together. That can also be very additive as well.
So, Justin, it seems like the world is becoming more uncertain, certainly from a macro viewpoint. Can you give us an idea of how you're positioning the PSG Balanced Fund given this growing uncertainty?
Sure. Yeah, so when I look at it from the fund perspective, I see three main risks. So the first one would be inflation risk, and that's a really important one for long-term savers. The second one would be really the global environment. Everything you see in the headlines with Trump and geopolitics and tariffs and the US deficit and debt and all that good stuff. And that's quite pronounced at the moment. So I think from certainly over the last 10 years, I think we're living in a very interesting macro world. So it presents some risks and opportunities. And then the third one would be the classic one of just how do we manage the risks in SA? Because we've got an allocation to SA assets as well. So if I look at each of those in turn, how do we manage them? The inflation one, the important part is making sure you've got enough exposure to growth assets. So equities, properties, commodities, and well-selected ones. You're not overpaying for them. So that's kind of the core of what a balanced fund is. It's a high equity fund. Okay, so I think that's how we're thinking about that one. And we're also thinking very carefully in terms of our stock selection, that it's securities that we're confident will protect purchasing power when inflation rises. Okay, so they're going to be positively geared to inflation and not negatively geared. So that's number one. On the global backdrop perspective, that's always a hard one to manage because you can retreat into your shell and then not take enough risk, and that's in conflict with your first objective. To beat inflation, you actually need to take some risk. Okay, so how do we manage that piece? We did a number of ways. Number one is we diversify across the board, so particularly outside of the US. We think the US is quite a risky place to be, so we want to be diversifying outside of the US. We're using instruments like inflation-linked bonds, gold, commodities, energy, stocks, and derivatives. We use derivatives to also manage the overall market risk as well. So there's a number of things that we do there. And then on the SA risk side, we watch it very closely. Your key kind of mitigation there is, again, diversification. So it's making sure you've got enough offshore, enough resources, enough rand hedges to balance the risks that you are taking in SA, that you're not running an all-in bet on just the SA working out. And the other thing we're doing in SA is we're just selecting our securities very, very, very selectively. So we're not just buying everything. We're really trying to buy shares that we think of companies that will do well just in whatever macro environment. So a company like Discovery, we're very confident it's going to grow really nicely over the next few years. whether GDP is 0% or 5%. If it's 5%, it'll be even better. But that's almost like a cherry on top for us.
So, Justin, it's not just all about managing risk. You also have your eye on the long-term objective that this fund is trying to achieve. So can you give us an idea of where you're currently finding opportunities?
Sure. So the good news is that we're seeing opportunities in all the buckets. And that's really what you want to see. So we're not overly reliant on any one piece. So if you think about our objective is we're really trying to get that CPI plus 5 or better, emphasizing the better, because we're really looking at healthy double-digit nominal returns over time here. Very, at the top end of what the peer group is offering. That's really our ambition statement. And if I look about it, SA equities, I think, gives us a really compelling way to do that. So they look cheap, really good earnings growth potential for the ones that we're in. I think the packages there looks really attractive. Fixed income, really good real yields. I think both inflation linkers and nominal bonds. That's adding to that return profile and it's reducing risk along the way. And then our global and resource positions independently and in an uncorrelated way also look really attractive. So resources didn't have a good year last year, and we think we'll do much better in the years to come. And I think, again, we very nicely selected. We've diversified across platinum, gold, some of the diversified miners like Glencore. So I think when we put it all together in a portfolio, we construct it in an integrated way. We're quite excited about what's ahead of us from a return perspective.
Absolutely. Couldn't agree more. Justin, that's a great point for us to leave this conversation at. Thank you so much for joining me today.
Thanks, Audrey.